Alright, let's take a look at problem 5-26. On January 1st, 2013, Sledge had common stock of $200,000 and retained earnings of $340,000. I'm just reading the problem here, okay? Just reading it at this point. During that year, Sledge reported sales of $210,000 and cost of goods sold of $110,000 and operating expenses of $48,000. Now, on January 1st of 2011, Percy acquired 80% of Sledge's outstanding voting stock, and on that date, $68,000 of the acquisition date fair value was assigned to unrecorded contracts with a 20-year life, and $28,000 to an undervalued building with a 10-year life. And that comes from this paragraph right in here. Okay, then the next paragraph reads, just to the right of my mouse, in 2012, Sledge sold inventory costing $13,800 to Percy for $23,000. And of this merchandise, Percy continued to hold $8,000 at year-end. During 2013, Sledge transferred inventory costing $16,800 to Percy for $28,000, and Percy still held half of these items at year-end. Then, next paragraph, on January 1st, 2012, Percy sold equipment to Sledge for $16,000. The assets originally cost $24,000, but had a January 1st, 2012 book value of $10,000. The time of transfer, the equipment's remaining life was estimated to be 5 years. Okay, now they've properly applied the equity method to the investment in Sledge. Part A says, prepare worksheet entries to consolidate these two companies as of December 31st, 2013. Okay, now I've listed the first entry that I'm going to tackle here. What we're going to do is debit retained earnings for $3,200 and credit cost of goods sold for the same amount. Now, why are we going to do that? Well, we need to remove the unrealized gross profit from beginning account balances. So in 2012, Sledge sold inventory $13,800 to Percy for $23,000. Okay, so what we have is a 40% gross profit rate, and you would take the $9,200 divided by $23,000 to come up with that rate, and multiply it by the remaining inventory that was on hand. Okay, and they had $8,000. So see how that works? Okay, remember, we're starting with separate financial statements of both companies. When we consolidate them, we essentially add them together, but we have to eliminate double counting that's likely to result. And in this case, we had profit and inventory transferred from one entity to the other. Well, guess what? Transferring inventory at a markup really for a consolidated company is just moving it from one location to the other. So we have to record it back at cost, and that's why we're going to reduce that profit in the inventory. Since it's from an earlier period, it's already showing up in retained earnings, and that's why we're going to debit retained earnings and credit cost of goods sold to eliminate it. Okay, now I've split the screen so that we have the problem up top, and I'll show the next next entry that we would make. And the next entry adjusts the equipment balance to its original cost, and it adjusts accumulated depreciation to the correct consolidated beginning of the year balance. Okay, now based on the equipment that was sold, $24,000 less $10,600, I think that gives us $13,400 book value, and there was $1,080 extra depreciation that was taken in 2012. So the net reduction to the reported equipment balance would be a reduction of accumulated depreciation of $4,320. Now what that means is we've got an unrealized gain sitting on the books that needs to be adjusted. So we've got a $4,320 debit to the investment account, and what that does, it transfers the reduction in the net book value to the subsidiaries account. Okay, the investment account would be reduced by $5,400 from the original intra-equity gain and increased by the 1,080 of the extra depreciation. So if we take 5,400 divided by 5, we're able to come up with that 1,080. And what we're doing is using the equity method. Okay, so the end result is that we've got this entry that we have to make. And our goal is to get the equipment and everything stated at the correct consolidated balance at December 31st. Now there's some other entries involved, so we'll look at those in a minute. Okay, now you see the next transaction, which we're calling entry S. And this one is the entry that we have to make to eliminate the subsidiary stockholders' equity accounts after we've adjusted for entry G above. And then we need to recognize the non-controlling interest balance as of the beginning of the year. So we've got the 200,000 coming from right here that needs to be debited. To eliminate that, we need to adjust for retained earnings. We need to adjust for the investment in Sledge. Okay, and then also show the non-recording interest. And remember, Percy only had 80% of Sledge, so we've got a 20% we need to consider. Okay, now the next entry we're calling entry A, and this is the entry that we have to make to recognize the acquisition date fair value allocations adjusted for in the second year of amortization. Okay, now remember, we're making this entry because we start off with the books of both companies as separate entities, and now we're in the second year where we've got to mark up the contracts and buildings of Sledge's outstanding values that we said apply to unrecorded contracts and undervalued buildings. So we need to mark it up less the appropriate amount of amortization, right? And we do that by increasing those assets, and then we take the offset to the investment and equity account, as well as a portion of that offset going to the non-controlling interest in Sledge. Okay, the next entry is to remove intra-entity income. And that's the income accrual recorded by the parent, since it's using the equity method, right? So it had 43,400 of realized income, and I'll show you where we came up with that, plus the 1,080 of the removal of the excess depreciation from 2012 from the intra-entity equipment transfer. So the net result is a debit to reduce the equity income that was recorded and to credit the investment in Sledge. So let me slide this up so you can see how we came up with those numbers. If I can do this, we should be in good shape. Yeah, let me slide that up a little bit. Okay, so you can see that now. What do we have? The subsidiary had revenues of 210 less cost and other expenses, and then we had excess acquisition fair value amortization that we had to show. So we wound up with net income adjusted for amortization of 45.8, right? There was some upstream inventory transfers that we had to adjust for, as well as upstream inventory transferred for a different time period, both of those from entry G. Okay, so we wound up with the net impact of realized income from the subsidiary of 2013 of 43.4, and then 20% of that goes to the non-controlling interest in the subsidiary. Okay, so that's how we come up with the 43.4, and subtracting that out, we wind up with an equity adjustment of 35.8.